Okay, hello everyone. A very warm welcome to Oliveboard. This is Rohan Dange, your faculty for today. And in today's session, we are going to talk about a concept. So, without much of a further ado, let's begin. So, in today's session, we are going to talk about capital account convertibility. There are two types of currency convertibilities: capital account convertibility and current account convertibility. Now, you need to understand what is capital account convertibility and what is current account. There are two accounts, capital and current. Okay, so when you talk about capital account convertibility, it is about the ease and freedom in converting a country's currency into any other foreign currency, and vice versa for capital account transactions. Okay, so for example, if you are an investor from US and if you want to invest in India's market, so obviously you have dollar but you want to invest in rupees, so that is called as capital account convertibility, when you can freely and easily convert your dollar into your rupee, right? So that is called as capital account convertibility. Correct. So it is the freedom to convert the local financial assets into foreign financial assets. For example, an Indian, he is going to America, and if that person is holding cash, that is a local financial asset, cash in rupees. And if you can convert that cash freely in dollars, then that is called as a foreign financial asset. And if you can do that, then one can assume that you have achieved something called as capital account convertibility at the market determined exchange rates. Now, what do you understand by that? What do you understand by market determined exchange rates? Market determined exchange rates means in the market there is a conversion rate between rupee and dollar, between dollar and pound, between pound and rupee, and so on and so forth, right? So there are constant fluctuations, and because of that, you will see that according to that particular at that particular point, whatever is the conversion rate, you will get that amount in return. Okay, now any economy ideally wants full capital account convertibility. Why would any economy want full capital account convertibility? Because that would lead to unrestricted movement of capital. And unrestricted movement of capital is desired by nations, because when economies open up, they want the flow of capital into their economy so that it leads to growth and development, right? And sometimes whenever you see a situation of partial account convertibility or zero convertibility, then because it serves as a blockade or a choke point, currency or assets cannot be freely converted into the currency or assets of the finance of the foreign country, and as a result, investment can go down, because the investors start looking at that country as a what you can say, as a country which is not investor friendly. Correct. So, in India, full capital account convertibility of Indian rupee was not introduced because the conditions were not in favor, as India was facing a large current account deficit. Right. So, on current account, basically, when India have to make payments on their import bill, payments on their import of gold, payments on their import of what you can say, oil, payments on the loans that the country has taken. So, that is interest payments. Since these payment obligations are very high, it is unadvisable for a country like India to go for full capital account convertibility. So the government wanted to ensure the availability of foreign exchange at lower prices for the input of essential goods and commodity. And India has been very cautious since the beginning with regards to converting, or with regards to migrating towards full capital account convertibility of rupee. Right? Why? Because of the Mexican crisis. We have taken, or we have learnt a lesson from that crisis. Around 1997, there was also an East Asian crisis where East Asian tigers like Taiwan, Japan, South Korea they also experienced a lot of slowdown and their economies had crashed for a brief period in time, right? So because of that, you see that there is more favor for partial capital account convertibility, because in a what you can say, in a nascent economy like India, or in a immature economy like India, or in a not so very well integrated economy like India, full capital account convertibility could lead to the what you can say, influx, too much of influx of dollar, which would subsequently depreciate the rupee to a large extent. And depreciation of a local currency only to an extent can be managed, but beyond that, that leads to a slowdown in the economy, that leads to a crisis or a crash in the economy. So partial capital account convertibility was always allowed in India, but that was largely conditional. Okay. So yes, the one great advantage of capital account convertibility, or the full capital account convertibility, is that it can increase the inflow of capital in the country. But if the conditions become unfavorable, there is a great risk of the outflow of capital from the home country. As I said, there could be a scenario where there is a flight of capital from the home country, and that can lead to higher volatility in the exchange rates and can even create a crisis like situation which happened during the East Asian crisis. So on one hand we want to serve our development purposes, but on the other hand we want to ensure that there is no flight of capital from the country, there is no what you can say, uh, rapid and radical depreciation in the value of rupee with vis-a-vis other international currencies. Okay. So there are certain preconditions which are important if you want to take a decision regarding achieving full capital account convertibility. Okay. So macroeconomic stability. Now, first of all, what are macroeconomic indicators? Macroeconomic indicators are indicators like inflation, current account deficit, fiscal deficit, gross domestic product. Basically, pillars which can talk about the health of an economy. So, if these conditions like the interest rates, inflation rates, gross domestic product, or the fiscal deficit, if these indicators in the domestic economy are within control, then you can say that the economy has achieved a adequate degree of competitiveness, at least in the domestic sector. Okay, and then yes, then that paves the way for capital account convertibility. Apart from that, you can also talk about trade oriented development strategy. So that must be adopted beforehand, along with sufficient incentives by the government for the growth of exports. Right. So if your external trade is steady, then definitely capital account convertibility can be achieved. So the industrial policy of the country should be attractive for investments, and the government should provide a favorable investment climate. Right. Apart from that, there should be sufficient foreign exchange reserves. Okay, if the country is sitting on large foreign exchange reserves, like for example dollar reserves, then what happens is that it makes the current account position also very stable. And as a result of that, since the current account is stable, money need not be diverted from the capital account towards the current account. Right, and therefore that is a condition which is required for allowing full capital account convertibility. Okay. So moving on, what is current account convertibility? Just like capital account convertibility, it means the freedom to convert rupee into dollars and vice versa regarding the import of goods and services. It also includes freedom to convert currencies to make or receive unilateral transfers like gifts, donations, and to pay or receive interest dividend. So interest payments come under current account convertibility. So India had moved towards a market determined exchange rate in 1993. Before that, it was a managed exchange rate. That means RBI used to manage the exchange rate. So that was artificial management of currency. But after 1993, we shifted towards a new paradigm wherein markets were determining the exchange rates. Then RBI announced in August 1993 that from August 20 of that year, India will become fully convertible on the current account. So in today's scenario, you can state that we have achieved full current account convertibility, but regarding capital account convertibility, we have achieved only partial capital account convertibility, because we want to have some cushion, or we want to keep our economy risk free. Okay. So, and also once regarding the current account convertibility, this happened after India accepted the status and obligations of Article 8 with the IMF, right? So this is about current account convertibility and capital account convertibility. So thank you for today's session and your time. I will see you in the next session with another set of what you can say concepts. So till the time we meet next, this is Rohan Dange signing off from Oliveboard. Thank you. Take care.